Today we'll talk about the reasons why your strategy might not be working right now and how to fix it. It's going to be a short video, so please stick to it. I'm going to explain the reasons why your strategy might not work today, and we'll go in depth on those. Most people tend to blame the wrong reasons for why their strategy doesn't work, and they want to change strategies every week. They want to have something different, something better. So we'll talk about this in detail. Okay, now the first reason why it doesn't work, we'll kind of clear out the obvious here, is because your strategy doesn't work at all, and it's a bad strategy. Now, I have a framework I use to kind of teach people that stuff and help them understand how to have a good strategy and what makes it more probable that the things will work out long term. And it kind of looks like this. So for you to have a good strategy, you need to be able to fit these different criteria. I call this the strong framework. So each of the letters of the word strong is a particular item in this where you have to follow it to have a good strategy. And I believe these things work really well. I've seen this work quite well. So I teach it that way to people. We'll go through each of them, of course. S stands for specific. So something that has clear rules, needs to be precise. I have some cheat sheets that I give my students to be able to do this better and kind of achieve that easier. But at least have some clear rules. That's the basic. That's the first part. If you just say I trade price action, that's not specific enough, right? That is just a guideline or a kind of framework or just like a set of principles of price action, but that's not a clear strategy. If you say I trade candlestick pattern, that's again too vague. What kind of patterns? Which one do you avoid? Which one do you take? Which ones are good? Which ones are not good? And how do you enter these patterns? How do you get out of these patterns? There's a lot of variables here for sure that you want to define. Now, T here stands for tested. So you need to test it. You know that is a big key. You need to be able to test your strategy in demo. You can even do some back testing if you want to before you go on demo to know your strategy works. If you've not tested it, you'll have a lot of troubles with the next steps. We'll talk about your mindset. We'll talk about risk management very soon. These things are all based on your tests. And of course, I cover this into my courses where I help people do this in details. I have a process for them to go through to backtest their strategy in detail, step by step. But anyway, replicable is very important also. Is whenever you create a strategy or whenever you find something online, you need to make sure you can actually execute it live. So you need to make sure you can take trades. It's very cool to look at it like on past data. That's very nice. But what about like taking it in the market? There's some strategies that are very easy to see, like support resistance or Fibonacci on past data. Look at a chart, you open it up on TradingView, it's super cool to see. Like you see all the setups, looks amazing. But when you go to do this live in the market, it's different. The lines are tougher to draw live in the market. The Fibonacci levels are tougher to see. Like you cannot really know where you should start, where you should end it. And that's kind of a tricky part. So some people can do it, some people cannot. Some people have to train themselves to do it better. Can you replicate this live in the market? Okay, now organize is a big one. So it's a strategy made into a structured plan and make sure nothing is forgotten or badly executed. Now we'll talk about this next because the next part is about your mindset and how you actually take trades in the market. It's very good to have a framework, either a checklist on your desk, something you can follow, something you never miss a step on. Otherwise, it's tough, like especially in the beginning. People have these guidelines, these things they want to trade. They have this candlestick pattern they want to think about. They have this thing. Then they go in the market and they want to do it. But then they see this other pattern, this head and shoulder coming up. And because of it, they don't take the trade because they're afraid that the trade will not work out based on that next pattern they see in the market. So instead of doing this, why not just have a framework that you organize and you can just go through it like a checklist or simple plan that you go through and execute on. And if you think something else is going to affect your trades, but it's not in your plan, you don't think about it, you leave it in the side and you take the trades anyway. So if you want to do this even better, I have a template that I call the one-page trading plan. I'll leave it link in the corner over here so you can check it out. It's basically a one-pager. We can just write your strategy in it. All the steps are there. So you kind of write your setup, your entry, your exits, and you think about your rules for managing the trades, what's your stop loss, your entry. Having this on your desk makes it a big difference. I always have one of mine next to me so I can know what I trade. I can know my strategies. I have one for each strategy that I trade. And sort of like a playbook, which I'll talk about pretty soon. But you can have this next to you and you can use this to plan out everything about your strategy. It doesn't have to be complicated. It doesn't have to be like a 10-pager thing where you have all your rules and your details, like a big trading plan defined. It can just be one page. I've seen this work really well. And I'll leave this link below as well so you can check it out. And you can watch a video where I teach you how to use it step by step. But also make sure you download it so you can use it by yourself and plan out your strategies that way. Okay, next we go to non-complicated. Now this means your strategy can be executed by almost anyone. And we do this by not adding too many rules. So that means that if you have like 100 rules or you have like 5 indicators in your chart, that stuff is complicated. And it means that it's probably going to be curve fitted because the more variable you add, the more likely your strategy is to be curve fitted to past data. Now, if you have only one indicator, well, it's likely that it's going to work long term if it works. It's likely that things are going to work out because you actually have an edge. If you have too many variables, too many indicators, too many things on the charts, then it makes it likely that it's just like basically your luck. And it might not work long term. Now, you've probably heard many traders say that the best strategies are the simplest one, where it's actually like a very simple logic that people execute on with maybe one indicator, maybe no indicators at all, and they can just like follow it and just do it. And it makes sense because there's a logic behind it. There's an actual edge. It's not just a set of indicators combined to kind of hopefully trade profitably. Okay, the last part is a good one that I kind of like to talk about, and that is about having a strategy that's grounded. And we kind of touched on this before, but the idea here is to have something that is based on logic. If you trade based on the phase of the moon, that could be cool. That's a nice scenario, a nice maybe strategy, but it's not based on logic. How does the moon impact the market? Well, we don't know, right? If you trade based on which charts align with your charts, that's also not really logic. Some people do it, they can make money with it, but I doubt there's some logic behind it. Therefore, it probably won't work long term. It could be a luck, could be based on like past things that they kind of curve fit, but not based on actual logic in the market. So what's the logic behind your strategy? Do you have a guideline? Do you have an idea why it works or why it doesn't work? I know my setups are based on reversals, and I know the price is likely to reverse at these levels because they're strong levels. And I also know that I have some kind of guidelines in place to look for extreme points in the market. Therefore, what is at the level that's likely to reverse, and you get some sort of extreme point in the market, I use Bollinger Band for this, then I'm able to know there's a likely chance it will reverse and go in my favor. That's the kind of logic you want to aim for. If you trade trends, why is it likely to trend or go back on the trend with your setup? What makes it likely? What's the logic behind it? It's important to understand, not just because it's interesting, but also because you can actually improve your odds and you can find out why it works. And then you can see when it doesn't work in the market and how to avoid these times. So some cool stuff in there. Another thing I kind of tell people to do in that regards, in terms of being grounded, is following the process for your technical analysis. And this is something I usually share to only my paid students. So you have a pretty good bonus on YouTube to kind of go through this with me. But the idea is to have some kind of process to go through when you look at the market and look at analyzing the charts and taking trades. Now it starts with the market phase. You try to understand the context first. How's the market behaving? And this is a lot cooler when you look at it on the chart. So you see price going up and down, hitting these levels. The idea is we want to find out if it's going sideways or if it's trending, basically. Now, we could look at a bit more stuff than this. We could look at the volatility. Here's a market where we are clearly sideways. You see reverse every time we hit these levels. And that's kind of a good place to look for bullish trades at the support and selling at the resistance over here. If you look at a market that's more like a GPUSD right now, it's more trending, right? We're more going up. We had these resistances in the past. We had these nice sideways market, but now we're more in a trending phase, right? So we could look to buy on moving averages, or we could look to buy on trend lines, or all other ways we can look for trending markets, even breakouts within that trend. Now that kind of tells us what we're looking for in the market, right? That tells us we're looking for some kind of trades in the trend. So here will be bullish trades if we're looking for GPUSD, or it will be maybe some buying also or selling based on USD Singapore dollar in that case. So then we look at some levels. Okay, I call this here support resistance, but keep in mind these are levels. You could look for a bunch of other ways. Okay, there are zones you look for a move in the price. Those could be Fibonacci levels. Those could be moving averages. Those could be the horizontal line you see on everywhere online. They could be trend lines. There's many ways you can look at these zones. Okay, you pick your favorite and you kind of go with it. Then we talk about price action. Price action is where you look at the patterns in the market. So all the charts pattern you see online. You could look at the candlesticks also to kind of figure out if you have a good chance that price will go in your direction. For me, I love to look at engulfing candles. They work well for me. For some people like pin bars. There's a bunch of like 1,000 different words for different candlestick, which you could use that. But you pick the one you like. It doesn't matter. It could be anything. And lastly, we look at if you want to add a bit more confluence. Now, we don't have to necessarily, but if you want to have a bit more confluence, we'll look at indicators. Now, indicators are cool because they help you to have a very clear, objective way to look at the market, not based on you, but based on the actual numbers of the indicator. So it's a bit more objective, which is a cool thing. I like to have no more than one indicator, and kind of picking the right one depends on the kind of setup you look for. If you're in a trend or if you're sideways, that it will vary a lot. And we could dive into this in future videos if you want to. Some people don't like indicators. That's fine. Too bad for them. Some people like them to kind of add more confluence, and that's cool. Sometimes you can really filter out and improve the results of a basic price action strategy with an indicator. So it's good to have to kind of improve the odds. Okay, and that gives us to now we've talked about the strategy part, which is what people will always blame for the strategy not working. But there's a lot of other things you can think about. Now, there's two reasons why strategy might not work out, and I'll go through them in details. The first one is your mindset and your execution. So if you have a good strategy, but you fail to take the right trades, it won't work. It's not going to be profitable for sure. So taking the right trades, executing on your plan is a big key here. And if you find yourself over trading, under trading, so you skip some trades, or you find yourself having emotions that kind of interact with your trading, or you find yourself just like plainly not taking the trades you should take, being scared of going in the market, having fear, or lacking patience. These are all things based on your mindset you need to work on. And I've done other videos in the past on that. There's a lot of topics to cover here, but I'll kind of link this if you want in the corner over here, so you can check it out by yourself and kind of see how to work on these things by yourself without paying for a really expensive coach or all these other things that you could decide to go on. Which brings us to the last part, and this is the one that most people won't blame because they think it's easy, or they think they can make a lot of money trading with a bad strategy, or even with any strategy that they can think about. And I'm talking here about risk management and blowing up. Now, blowing up doesn't mean you blow up your whole account. It could mean you have some good wins, but then you lose a big chunk of profit in just like 1 day, 1 hour, like really quickly. That's what I call blowing up also, is where you have these good runs, then like a really big bad run, then you lose all your profits. That shows bad risk management. It could also show bad mindset, but mostly bad risk management. Your risk management should be doing 2 things. First one is protecting your account, so not blowing up your account, not losing too much money. But the second thing is achieving your goals. So how can you have a better risk management to achieve your goals? Your goals could be different. Your goals could be to just like protect your money a little bit, make some small wins. That could be a goal. The goal could be to be more aggressive. And that means you got to balance both things a bit better. So like not blowing up your account, but also having some decent profits and maybe a bit of increased drawdowns that you can tolerate. People will have different levels to where they respond to drawdowns. So some people, they can handle big drawdown easily. Some people cannot. They have to have really small drawdowns and not be too overwhelmed or not fearful of the market. It depends on you. You pick what you prefer here. But learning about the different ways to manage your risk can be useful. There's a really good book on this by Van Tarp about position sizing. That's called The Definitive Guide to Position Sizing. Good book to read if you want to have a better understanding of how risk management works and how you can risk different on trades to be able to get better results. A really cool book to read. A little bit dated, but a really good book to go through if you want to be more advanced in that. I'll leave a link below as well if you want to check it out. But that's it. So 3 reasons why your strategy might not work out. First of all, the strategy itself. Most people blame it, as always. Or they blame the broker, they blame something else why the strategy doesn't work. The second thing is your mindset and your execution, so how you take trades in the market and how you handle the mindset part of trading. And the third reason is plain and simple, risk management. How you manage your risk, whether you blow up your account or not, whether you lose big chunks of your accounts or not. And that makes it for a complete answer. So if you have any questions or if you have any comments on this, make sure you comment below the video. I'll be happy to read your comments. I read all of them. I don't reply to all, but I do read all of them every single time. Make sure you're subscribed if you're not done yet. I publish 3 videos like this every single week. And I'll catch you back here in the next video pretty soon. Ciao.